All right, and welcome to our hopefully final tutorial video for our personal finance final project video. I'm Mr. Murphy, and this video we're talking about our retirement accounts, investment in the market, and our savings goals. First, let's start with our retirement goal. Why is it so high? Well, we go over here to our assignment, and one of the links is the 7 important money ratios. Mind you, these are all suggestions. One of the ratios is save 25 times your current income, and that should be your total retirement savings. So we go back to our sheet. Bob currently earns $45,500. 25 times that is over $1 million. See how his retirement goal is going up? That's because his salary, of course, is going up every year with his 3% raise, as you all have. So what are we going to do to put money into this? Well, let's look at one of our ratios again. We go to the top, and one of the suggested ratios is 20, 30, 50. 20% should be put towards savings or towards paying down debt. 30 for housing, 50 for everything else. Well, we've already done housing, and we've done pretty much everything else, so we put the rest into savings. But how are we going to break that up? Well, it's really up to you and what you think is going to be most important. Again, these are all suggestions. So let's go back here and let's go to our next account, or skip the stocks. We'll go down to our savings. Where does this come from? This number is, let's go back to our ratios, 6 times our monthly expenses. So essentially half of a year's expenses, and we already have a full year's expenses right here. So 1/2 of that is going to be right there. Now, as we go through, this might increase due to housing increase or whatnot, but right now, this is what we have. And then finally, we have our stocks. So this is where you'll put in stocks either in risky, think you personally investing in the stock market, you pick out a stock, you invest, and then we have over here safer funds and bonds, think mutual funds, government bonds. Someone else is managing your money and they kind of know what they're doing. Maybe they really know what they're doing. Or the bonds, you're essentially gambling on the government. Do you think the government's going to do well? Well, they've probably promised you a certain interest rate that says we think we're going to do this well year after year. So what we're going to do is we're going to break down all this money, and whatever we have left over is our free discretionary spending. Think, I want to buy a jet ski, I want to buy clothes, I want to go out to dinner, I want to go to a movie. Anything like that that isn't a recurring cost, that's free and discretionary spending. Maybe it's something you prioritize, maybe it's something you say, whatever I've got left over. Okay. So we're trying to build up over $1 million, and you want to get there by the time you retire, and you notice it's going up because your salary is going up. So how are we going to get over $1 million in 30 years? And by the end of it, it's almost $3 million. So we're looking at $3 million in 30 years. How much money are we going to have to put away every year? Well, let's do some math. Go over here, 3. We're looking at $100,000 a year. Is that reasonable? Well, no, that's super hard. So what are we going to do? Well, we're going to have to put money in and have it expand by someone else's volition. And what are we going to do? And we're going to see that result. Well, we can put money into a retirement account and have someone else grow it for us, put it into these safe bonds, grow it for us, or put it into the risky and try to grow it ourselves. So let's go ahead and put $2,000 into a retirement account. Notice the money goes up because, of course, the retirement account gains value over the course of its life. Bob thinks he's okay at the stock market. He's not going to invest a whole bunch, let's say just 1,000. All right. And at the end of the year, he got his total current risky stock value was 1,000. So he didn't make any money, he didn't lose any money. Safe bonds, he wants to trust someone else with his money. Let's go 2,000. Again, same amount, it didn't go up or down. Total market investment, 3,000. Total market value, 3,000. Money left over, well, we spent, let's see, 2,000, 1,000, 2,000, 5,000. We have over $9,000 left. Let's put $6,000 in savings. And that leaves $3,786 for the rest of our spending for the entire year. Thank you.